Hi everyone, this is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I had him on a couple months ago. He's an editor at Wealth Research Group. He's a successful entrepreneur and he's a former money manager. Lior Gantz, thank you for joining me again.
Jason, thanks for having me.
Now, Lior, since the last time you were on, there's been a lot that's changed in the macroeconomic situation. The Fed just hiked rates again. There's been huge problems with the European Union and Italian banks. So let's talk about your views on the global macroeconomic situation and maybe how that's affecting some of the different markets.
Sure. Quite similarly to 2 months ago, the trend is still to tighten monetary policy in the U.S., and to raise interest rates to a level that doesn't create a problem for the United States government with regards to their borrowing costs, especially with the tax reform. But on the flip side, that it doesn't create a situation where the Fed has to chase inflation because it cannot do it in the same way that it did in the 70s. If you take a look at both situations, there are quite a bit of similarities and quite a bit of contrast. But what is definitely true is that the United States was the greatest creditor nation in the world back in the 70s, and now it's the greatest debtor nation. So you cannot create a situation where the Fed raises interest rates or the Fed's fund rate to about 18% as it did in the 70s. That's just unsustainable, unrealistic, and not plausible. So they have to make sure that the economy doesn't become overheated due to many things that are happening right now. But the big ones are that the sentiment, the optimism from small businesses and from consumers has never been higher, at least in the past century. So this is talking volumes with regards to how Trump has been able to create a situation where the administration is showing strength and people are buying into it. You can see that in the dropping of coin sales and bar sales and bullion sales for all the dealers across the U.S. If you call dealers, they'll tell you that it's the worst it's been for many, many years. So the economy, or at least the facade that everything is going great, is there, and the facade is important because people think with their emotions and not with their logic most of the time. You see another great headwind for the economy, which is the fact that that openings for jobs are at all-time highs. The reason being, there are two reasons for this. One, the participation level is the lowest it's been. In other words, more than 100 million Americans are out of the workforce, most of them permanently, either due to retirement or other issues. But if you have 100 million people not working, it's easier to find jobs for the 230 million other people that are seeking a job, not excluding obviously children. So there's 6.8 million openings right now, which millennials are having a hard time filling because people do not want to hire them. They're undertrained and they're not experienced. So what happens is companies rather assign higher wages to people that have the talent, that have the skills, that have the experience, and therefore you're seeing wages going up. And it's important, Jason, because people sometimes feel like commodities are what drives inflation inflation higher, and that's not true. In a loaf of bread, for example, that costs about $1.50, there's about 7 cents worth of wheat. If the price of wheat doubles, almost nothing happens to the loaf of bread price. But if the wages for all the people in the supply chain go up, then the price of the bread can double. And that is the situation that is currently happening in the United States. I've listened to the shareholder calls for Kimberly-Clark, Colgate-Palmolive, General Mills, Tyson Foods, many of the big, Campbell Soup, many of the big ones, and they're all talking about costs going up, having to pay more in wages, more in overtime, people quitting their jobs, to find better jobs. So there's definitely a pressure on the employer right now to make it work for their employees. So these are things that are pushing the United States economy up. Obviously, with people having about $1,200 worth of tax cuts on average, time that by 200 million people, that's a lot of money that people have now that they didn't have before the tax reforms. And then lastly, and this is obviously very important, there's an oil renaissance going on in the United States from a country that used to import all the oil onto their soil. They're now becoming a net exporter, and couple that with the fact that China is becoming a service economy with a bigger middle class, and you see why the United States has more to offer right now to China than it did before, where it was a relationship dependent on the United States issuing debt and China buying the debt in exchange for U.S. consumers buying tangible items and basically helping China become a more robust economy. So kind of a lengthy answer, but I know your audience is extremely sophisticated because I've listened to many of your shows and you ask phenomenal questions. So just wanted to give you the full rundown on this. And then just to kind of cap this off, I think what's the most important thing for any investor right now is to watch how the Fed funds rate, currently at 2%, how it catches up to the 10-year yield. Because when it does, then the recession becomes imminent and looming and not just something that's in the horizon. 2% for the Fed's fund rate. The 10-year bond is right now about 3%, yielding 3%, depending on when you're listening to this interview. And when it catches up to it, so in about 3 or 4 rate hikes, if they keep raising rates by about 25 basis points, then you're going to see a real problem. And obviously, this is like 1 year away.
Yeah, we're recording this interview on Thursday, June 14th, for the listeners out there want to keep track. So I think, Lior, you touched on a bunch of different cross currents going on. So on the one hand, we have a stock market rally in the major stock market indices. We have the NASDAQ and the Russell 2000, which is the small caps, which it would confirm that small business confidence, you said, are at all-time highs. So that's on the one hand. On the other hand, though, we have the dollar index now, which has been having a rally for 2 months, and the dollar index is almost at 95 again. And I've done short videos on the dollar index. The dollar index could get to 100, 102 probably on this rally before it starts to cause major problems, although George Soros gave a speech earlier this month saying that he thinks the problems are more acute, and he thinks that a dollar at this level will cause problems. So, in terms of the global economy, I think the U.S. on a relative basis right now looks safer and probably stronger, even though the economy is probably creating mostly part-time jobs. And I think what you said on the conference calls, I would agree, that would confirm my stagflation thesis that there's a lot of problems in the rest of the global economy right now compared to the U.S. So the U.S. has a lot of long-term problems. We've discussed this at length, with the budget deficits, the unfunded liabilities, all these problems. But, in the short term, they don't. The other countries don't have the world reserve currency. So the U.S. can paper over these problems more compared to the other countries. I mean, look at the balance sheets now of the Bank of Japan, the European Central Bank, and the People's Bank of China. They're all over $5 trillion, and they've grown it just in the last, couple years. There's been an explosion in that. There's a huge credit bubble inside China in their banking system and their shadow banking system. The People's Bank of China's balance sheet now, they have $5.6 trillion US dollars worth of assets, and I'm using air quotes. We don't know if they're marking those assets to market, what the real value of those assets are. They also have over $35 trillion US dollars in credit and liabilities. So their balance sheet of the People's Bank of China is leveraged at over 7-to-1. There's been warnings in the last, 8 months from 2 different PBOC officials. One of them said 80% non-performing loans in the Chinese banking system, and one of the worst housing probably the worst housing bubble in history. And that's like 60% of their economy. And, the reason I think the dollar index, Lior, and you can chime in on this, the reason the dollar index is having this rally is almost all entirely, in my opinion, because of what's going on in Europe with the Italian banks. People are worried about the European Union, the social and political problems there as well. So the European Central Bank has said that, they want to reduce their balance sheet, they want to raise interest rates. I don't see it. In fact, there was a speech recently that one of the top institutional banking analysts was at in Paris, and he said there was an ECB bank governor there, and the guy said they're going to have to reinvest every single amount of interest that they're getting on all their QE bond buying from corporate bonds and stuff. They're going to have to reinvest it all, and the ECB balance sheet is already over $5 trillion.
Jason, I think what you said is probably the best analysis of what's going on that I've heard in a while, and I couldn't agree more. And I think the question is not whether or not you know this information, but what do you do with it? And it's just important to understand in this context that all of these things are very true. And then, so how do we prepare, anticipate, capitalize on what you just said? And our major theme right now at the Wealth Research newsletter is how to prepare for what we are calling de-dollarization and the last great decade of the American empire before this becomes officially the Asian century. Let me explain what I mean by that. Every 10 seconds, there's a baby boomer retiring, celebrating his 61st birthday and exiting the workforce. So there's a huge money transfer, a wealth transfer, an opportunity transfer from the older generation now to the millennials. And in the next 5 years, as they become more trained and better experienced and have everything going for them, they're going to have what the boomers had in the 1980s, which is peak earning years, and they're going to start buying homes, cars. The United States is going to experience a nice booming economy. Whether or not there'll be short-lived recessions, sure there will be. No country ever has ever runs a marathon without taking a breather. So there's definitely going to be recessions in the next 12 years here between now and 2030. But the U.S. economy is in a very nice situation demographically, which it has not been in for about 18 years. So since the year 2000, where boomers were much more dominant in the economy than the millennials, because they were only kids and they didn't create a lot of trends or economic force. Right now, demographically, in terms of numbers, millennials eclipse the boomers in terms of numbers, and this is very, very, very important. So this is one thing that's important. Now, on the flip side, the Chinese GDP will become the world's #1 by 2025. So in terms of who has the bigger economy and who has more pull at the IMF and at the BIS and at the global levels, China will start having more decision-making powers starting 2025, and this is very important for the United States middle class because it will hamper the ease with which the United States runs deficits, the ease with which it creates huge military spending, and the ease with which people are consuming and enjoying great lifestyles in the Western world. So it's going to become a situation where it's like in Europe or in Australia or any other developed nation where about 10% of the people are very well off, they have lots of assets, and the rest of the people, the 90%, are most likely having a permanent job, but they can't really create a sustainable wealth or build a lot of assets. So this is important. In the next 7 years, you got to figure out where you're at, build a very, very very sustainable career in an industry that will not get outsourced, that is permanent, that is more sustainable, and you got to build an asset base. You got to save up. Then 10 years later, by 2035, Jason, China will have a bigger military than the United States, and this really comes in to where the U.S. will cease to be the reserve currency of the world. So there's big changes coming, the biggest, at least in the last 100 years, and these are all coming in the next 10 to 15 years. And as you know, the market doesn't wait for 2035 to get the official notice that China is now the biggest military power on the planet. It starts pricing things well ahead of that. And so these are big things, and we will cover everything with regards to that in the next 12 years in the Wealth Research letter. And you can go even and check out my personal portfolio at wealthresearchgroup.com/portfolio on how to prepare for this. The biggest the biggest trend with regards to this is how you prepare a precious metals position in the right way, and then how do you prepare for massive gains in the biggest trends. So both China and the US want to become the superior tech industries, the superior tech empires, and they are both investing tens of billions in AI or artificial intelligence and in decentralization or blockchain technology. So lots of opportunities in both of these sectors, and we can touch upon that. In the end, short term, and you've asked me about this. So here's kind of where I'm at with this. The dollar can rally, and it can rally to 102 or even 105 on the index, but that doesn't mean that gold has to go down. So when you see a gold to dollar price mechanism, that's one thing. But if you look at the dollar, or I'm sorry, at gold priced in euros, it actually is at a 52-week high right now. So just important to understand, you do not own precious metals just to protect yourself from the US dollar. You're protecting yourselves from fiat currencies as a whole. My personal allocation is I just took my lifestyle burn rate. Whatever I spend in 1 month, let's say just for ease, it's $10,000, and then you multiply that by 24 months or 2 years, so that's $240,000, and you just convert all that fiat into gold and silver physical form. You store it either at your main residence. Obviously, you don't want to store that amount in the main residence, so you move it onto vaults. You can do it in the U.S., Canada, Austria, Hong Kong, Singapore. You can spread it throughout various storage facilities, and you never touch that again unless you need to. So unless there's a catastrophe, you have 2 years worth of 2018 dollar purchasing power, but you know that if something really happens, that can really become a wealth scenario for you, because if people lose all their cash savings or a lot of their cash savings in higher inflation rates, your precious metals will actually gain in purchasing power. So I never touch that, and that is my core precious metals position. Now, on top of that, if you want to bank or you want to capitalize on price rallies with gold and silver, then I stick most of the time with either the mining shares or some of the ETFs. It depends on what I want exposure to. If I'm short, if I'm long, if I'm just short or just long, etc. So, kind of a big scenario picture for everyone listening.
Well, counterintuitively, the gold price has actually risen when the Fed starts hiking rates. So maybe it's inflationary expectations picking up. Maybe the market is worried that raising rates will cause problems in emerging markets who have overborrowed in US dollars. You mentioned the dollar index there. I mean, if the dollar index gets to that 105 scenario, that's going to cause a lot of problems in a lot of different emerging markets.
Oh, yeah. The emerging markets are suffocating. They're in the dollar shortage. They are calling every bank possible to get their hands on dollars, as funny as it sounds. So
I don't like people call it a dollar shortage, but I would just say it's irresponsibly borrowing in dollars, and so they need to pay it back in dollars. They're gambling that the dollar would be weak and that they could pay it back. But almost all the times that either emerging market corporations or emerging market governments go bankrupt, they almost always over borrowed in dollars, and then their currency became really weak against the dollar.
True, a better way to say it, for sure.
Yeah, so the last time you were on was in February, and you thought that gold has bottomed. We've had a couple rate hikes since then. Gold hasn't crashed. It also hasn't gone up much. Do you think that's mostly because we're at like 1301 gold right now, but silver is actually starting to rally? Silver had been pretty weak for a while. It's actually over $17 now when we're recording this. So do you think then that temporarily the dollar index is going to be a headwind?
Okay, so first of all, with regards to silver and gold, silver is in a very good situation right now because as you know, most of the time, 90% of the time, people use it as an industrial metal nowadays and not as a precious metal. So it has this dual mandate that it can rally on inflationary pressures within industry. So if economies are booming, it's more prone to rally. It touched the 80-to-1 ratio, even touching 82-to-1 to gold. So it's definitely in a situation where it can outpace gold for the short term. In terms of the outlook for gold and silver, and again, what I want is for people to understand that I do not buy gold or silver in order to sell gold and silver. If I want to speculate on the price movements, I am much more inclined to look at my favorite names, the favorite management teams, and which companies are selling at less than liquidation costs or less than their cash in the bank, something that is very, very undervalued, and put my money in there. And we can talk about that if you want, but we've written the lengthiest manual about gold investing that I've seen online, and you can go to wealthresearchgroup.com/gold playbook and download that and have a nice weekend read, because you can get a great education on everything that has to do with the gold industry and the silver industry. With regards to where gold and silver are, as you said, counterintuitive to what many people think, when you lower interest rates, it doesn't immediately cause the price of precious metals to go up, because what the Fed or any other central bank is indicating when it lowers interest rates is that it's fearing a deflation, and therefore the market is not fearing inflation from lowering interest rates. They are fearing that there's a real slowdown, and so it's a more complex than where interest rates are. The real question is, how much investment demand is there for gold and silver, and what the price of oil is. The price of oil dictates the production cost of gold and silver to a large degree. So as oil prices rise, as they are right now, from 30 to about 70, almost doubling, that helps to create a gold bull market or a silver bull market, as we are in for the last 2 years, though it's a very modest and very moderate bull market. And I can talk about what that means for the near future, because it means that it's going to compensate and become a more aggressive bull market. But because gold is only up 22% since it's bottomed at $1,053 in December of 2015. So if you look at where gold and silver are at right now, with the Fed raising rates to 2%, the real interest rates, which is the Fed's fund rate minus inflation, is still negative. And therefore, there's a lot of reasons to still own gold if you're a big institution, if you're a government, if you're a fund, and allocate into that. So definitely the price movement is going up and not down. And whether or not it will rally or not, that's another question, and when it will happen is another question. But our long-term projection is that gold will end this cycle at $1,700 on the conservative side, and about $1,900 on the more speculative front. And this is in 2-3 years. So this is where Wealth Research Group stands with the price of gold. With the price of silver, we see about a 55 to 50 to 1 ratio. So wherever gold is, you take about 55 or 50 and divide the price of gold, and that's where you're going to see silver.
The yield curve is also flattening too, despite the Fed rate hikes, which is not what the Fed wants. So normally a flattening yield curve eventually can lead to a inverted yield curve, which normally signals, at least in the past, it signals that there's according to government statistics, a recession. Bad things are about to happen in the economy. So I'm not saying it's imminent that things are going to happen, but maybe in the next couple years that's going to signal something bad. But I think this dollar index rally, unless things get absolutely dire in Europe or the European banking system, I know they're doing backdoor bailouts right now, but unless things get totally out of control, come October, Lior, I think this dollar rally that we've had for 2 months now, and maybe it goes on a little bit longer in the short term, but around October, I think things start to get pretty dicey for the Federal Reserve, for the U.S. Treasury, because the Federal Reserve is supposed to ramp up this quantitative tightening. They're supposed to start selling the balance sheet has gone down a little bit over $100 billion, so it is in a downtrend, although, when you have a $4.5 trillion balance sheet selling off $100 billion, a little over $100 billion in assets is not really that much. Plus, the Fed has a bunch of over $1 trillion in mortgage-backed securities it really can't sell at all. So once we get to that October timeframe for that quantitative tightening, that's going to be an annualized pace with the $50 billion per month in asset sales. That's going to be about $600 billion per month. And then you have all these borrowings that were delayed for the budget deficits and stuff. Because the one thing about the tax cuts, I love tax cuts, good for the private sector. The government didn't cut spending. It was debt finance. So in the long term, that supply side economics, the U.S. national debt is already large. It's almost $22 trillion. There was no corresponding cut when there was private sector tax cuts in government spending. So we're looking at, big long-term consequences because of that. And on top of this, the Treasury is going to have to sell in the next 12 months over $1.2 trillion in Treasuries. So, and I don't know who the buyers are going to be and at what interest rate. So we'll have to see what that's going to do to the dollar and what that's going to do to interest rates. Because if the Fed wants to sell, assets and the Treasury needs to sell more Treasuries, I don't really see how that's going to be good for the dollar unless there's, all these problems in the emerging markets or Europe or China or Japan.
Well, and Jason, remember that in 2010, so 8 years ago, when the Fed started QE, that's when the Chinese and Japanese demand for treasuries flattened out. So for years and years, the Chinese and the Japanese kept buying more debt. Now their debt level or their treasury holdings have flattened for about 8 years. That's why the United States government had to use the Federal Reserve in order to keep doing what it's doing. In the 1990s and in the early 2000s, China was the cheapest manufacturing country in the world, and it needed to build their economy using this hot potato system with the United States. Now there are 45 countries that manufacture cheaper than China. So that's about a quarter of the world's countries that are cheaper than China. And so China is becoming a different sort of economy with a big middle class, with a population that spends more, that wants more, and that consumes more, and therefore it's becoming more expensive than 20 years ago. They don't need the United States anymore as they did before. And obviously Trump knows this. That's why he's trying to strengthen domestic manufacturing and build hubs of artificial intelligence and technology into the domestic part, and obviously increase the infrastructure programs that he wants to put in place. And I think he will eventually also legalize cannabis, because these are very high-paying jobs, and they will bring a lot of tax revenue to the states, and they obviously in the future will bring a lot of technology, because a lot of pharmaceutical companies will come in with research and development. So there's a lot of things to look forward to, and a lot of things to understand, that they're not going to be any more as they were before. The future is not going to look like the past in terms of the relationship between China and the U.S. It's moving to a situation where 330 million Americans cannot be more productive than 1.4 million Chinese, and that's the bottom line.
Before marijuana gets legalized at the federal level in the United States, President Trump has to get rid of Attorney General Jeff Sessions, because that guy is like Mr. Reefer Madness. He's, if you've heard of that cult film, that was like anti-marijuana, that
Sure.
was blaming all the problems in society on marijuana. Jeff
Sure.
Sessions, I think, saw that movie in high school. So until they get rid of him, because he's still prosecuting like a lot of people for marijuana crimes. The prison system in the United States is ridiculously screwed up. There's tons of people in there for first-time offenses, for drug offenses.
Well, I think Trump indicated only 2 weeks ago that he's going to bypass any decision that is erratic by Jeff Sessions, and he will support the ending of federal ban of marijuana. And that's one thing. You got to remember, at the end of the day, he's a businessman before he's a politician, and the type of jobs and the type of savings in terms of tax revenue is already proven. Colorado has proven itself to be a very sustainable economy right now. California is making leaps and bounds, and you just can't let our friends in the north gain the upper end here in terms of not only legislation, but in terms of the amount of people and companies that will go there in search of good personnel, talent, R&D, and then export. So I definitely see the move that the Canadian government is doing as an instigator for the United States to do the same. So that's one thing that's important to understand here. And then overall, in terms of the support for this, it's becoming overwhelming. So the next president or the next term that Trump has, he will have enough support to just make it a very easy decision. Whether or not this will happen in his term or his next term or another person, the trend is clear, and we're past the tipping point. It's just a matter of when and how you can prepare for this in terms of if you're an investor or a career choice, or if you're in the ancillary businesses, meaning if you support the cannabis companies and not yourself grow it or sell it or do anything with the plant itself.
Yeah, I have a friend who moved about 8 years ago to Colorado to go work in the marijuana industry, and I interviewed him about 6 months ago, and he said, yeah, the industry is booming there, but they still, because at the federal law, and there's bank branches all over the country for a lot of these banks, they still can't take money from marijuana companies. So
yeah, they have to take security trucks come in every day like Brinks and take the cash. It's kind of a Wild Wild West mentality. So
yeah, that's part of it, and then they have to put money at credit unions, so they're not allowed to participate in the regular banking system completely yet. It's ridiculous. So that's why I think for right now the Canadian companies have an edge, because they're allowed to use regular banks. But I agree with you about the states. I mean, the states see that Colorado has all this extra tax revenue coming in. Look what the state of New Jersey did. They just legalized online sports gambling. They had already legalized, I think, at least part online gambling. So you're seeing states legalize casinos, either build casinos physically or online gambling, now online sports gambling with the Supreme Court decision. So I think, the situation we're in with the pension fund crisis and unfunded liabilities, and states talking about, the states like New York, New Jersey, Illinois, California talking about drastically raising people's property taxes, they need more revenue coming in. And people, if you raise their property taxes, how much they're going to move. So probably like things like legalizing marijuana, legalizing online gambling, stuff like that is a better compromise than just soaking people with higher property taxes.
Yeah, definitely. It's a changing economy and it's a changing world right now, and just important to adapt to it and not fear the changes that are coming.
So speaking of changes, let's talk about the cryptocurrency markets. I know you cover those extensively. So in the past, you correctly predicted, you recommended Ethereum, I believe, at $12 a coin and Dash at $30. And, even a month or so ago, it looked like that Bitcoin and some of the other cryptos may have bottomed. They have not. Bitcoin now, when we're recording this, is just below $6,700. That's right around the marginal production cost for mining Bitcoin for commercial scale Bitcoin mining. I interviewed Frank Holmes, the chairman of Hive Blockchain Technology, last month, and he said that the marginal production cost for a lot of the industry is $6,500. So what do you think happens if Bitcoin keeps going lower below the production cost of the mining? Do you think then that's the blood in the street type of scenario where it would be a skirming buy?
I think it's important to understand that Bitcoin has commoditized, and therefore it should trade just above its mining production cost going forward, unless there's a premium on it. Just as if there's a premium on gold at times, then it will trade at a large margin from production cost. But any commodity that a new entrant to the sector can easily mine for $6,500, the price will always be around that price. It's very easy to understand that. In other words, if Starbucks is producing coffee cappuccino for $2, there's nothing that stops me from doing the same thing unless Starbucks does it in a more efficient way than I can. And there's nothing stopping other people right now from entering the market and buying the machines and creating and mining Bitcoin or mining any other of the major cryptocurrencies. So the price pressure should always be down in terms of where commodities are going, but save for times that they command a premium. So if there's a huge problem and people really want Bitcoin, then they will bid up the price, and they will be willing to pay more than production costs.
But
if the Sure.
Sorry to interrupt you, Lior, but
Sure.
I would make the argument that Bitcoin was designed by Satoshi to be more like gold, so digital gold, whereas the price of gold has to keep rising because gold becomes more and more rare over time. That's why the cost to mine gold and gold hasn't become more plentiful. In fact, it's the opposite. We're now mining 1 gram per ton, and we're moving 2,000 tons of uneconomic rock now at a lot of gold mines just to get 1 gram of gold. It's insane compared to mining 50 years ago or 100 years ago. So I think Bitcoin was designed in that regard. You're mentioning how, the textbook definition of commodities and deflation, the costs are designed to fall. That's not how gold is in the marketplace. Gold goes up over time because the cost to produce gold, with the higher oil costs, you have to move more rock that's uneconomic, the cost of gold rise. So Bitcoin, and with its algorithm, Bitcoin over time, the costs are actually supposed to increase. 1 year ago, Lior, I think the mining cost for Bitcoin was $3,000. So
yeah,
I don't know.
We're not saying anything different. I'm just saying the cost of production is usually the spot price for the coin or for gold or for silver will always be hovering around the cost of production. If the cost of production goes up, then the price will go up, but it will always hover around that and not trade at a large premium to that, unless there's a justifiable reason. So, like you're saying, if it becomes harder and harder, and it is becoming harder and harder to find gold, then the price has a tendency to keep going up, but it will not go up more than the price of production in a very incremental way, unless there's a huge problem that creates a situation where there's a rush into gold. So we're definitely on the same page here. What I am saying is that what you saw last year in 2017, where Wealth Research Group, for example, covered Ethereum at 12, and 6 months later, people who took our advice made 90 times their money. I had a subscriber email me that he made over $150,000 on that trade, for example. That type of scenario will not return into cryptocurrencies because we do not have a rush into the coins right now. So that's basically the bottom line for me, is for people to understand that what we saw in 2017 was a generational, maybe even a centennial type event that doesn't happen every year. And for someone like me who has been investing since the age of 16, 18 years going now, and when I can create a situation where I make 12 to 13 to 15% returns annually in the stock market, this is hedge fund material, then obviously making 9,000% in 6 months, that is the something to make sure you understand it's abnormal, and you must sell on strength when this happens. So if you see something like that going forward, that's the anomaly, and you got to take profits and bank those profits. Make sure that you keep that money home and then reinvest it in undervalued assets. So I think we're talking about the same thing, but looking at it from various angles. Going forward, with regards to cryptocurrencies, they will need to figure out what their identity is. So a number of them, out of the 1,500 projects that are currently out there, and it's very easy to code another one and code another one and code another. So there can be an infinite amount of them. But what you need to understand is, what the audience needs to understand is, what does each and every one of them give? What is the value that you get when you own them? Some of them are great mediums of exchange. You can send value around the world, low fees, very quickly, very anonymously, and you own it. You own the code. It's not owned by the banking system. So that's the good currencies like Monero or Dash or Bitcoin or Litecoin. Then you have other type of coins or other type of tokens, and you need to really become a person who doesn't just throw an arrow or a dart into a board and thinks that each and every one of them will go up from here going forward. Another thing that I am very much focused on, Jason, is the difference between becoming an investor in cryptocurrencies and becoming bullish and an investor with blockchain companies, because blockchain technology is expanding into other areas outside of financial technology or outside of cryptocurrencies, and you can have huge exposure to the decentralization revolution without ever touching a cryptocurrency, or with touching cryptocurrency as part of what this company does and not everything, all the operations. So this is something that I am very excited about, and this is our main theme in 2018 for Wealth Research Group.
Yeah, IBM and Cisco, Microsoft, some of the other larger technology companies in the United States are already testing and working on implementing blockchain into different things. I know IBM's running a television commercial right now about tracking diamonds that are non-conflict diamonds from when they are mined to when, you go to the retail jewelry store to go buy a ring or a necklace or something like that that's made out of diamonds.
Sure. And you know what, Jason? I gotta really make sure that people understand, because this is, like I said, June 14th. Yesterday, June 13th, Wealth Research Group started to cover a company called Global Live Technology, and it was founded, and it's the CEO is a guy named Anthony LaCavera. You can Google him and see that he has his own Bloomberg TV show, made numerous exits in the past, including selling Wind, which is the fourth largest mobile network in Canada, to Shaw Communications for $1.3 billion. He owns 40% of the outstanding shares, and this company is the first one in the world to commercialize AI, or artificial intelligence, married with blockchain technology, and creating solutions, applications, and services with that regard. So just like Microsoft was the first to create operating systems for the PC revolution, and Google was the first to create a large-scale search engine for the internet revolution, this is the first company that is commercializing AI for the blockchain revolution. And I'm looking at the shares right now. It closed about 6% up today, and about 30% up yesterday. It's up like 50%, but I think it's only the beginning. Internally, looking at our own reports, we feel that the company is very, very undervalued right now, about 60% undervalued to where it could be, just judging by today's operation. If you want to take a look at the report that we create about the company, you can go to wealthresearchgroup.com/live. It's a management vetted by the company report about everything that's going on. And it's just an exciting time, Jason, and I'm glad that we are having this conversation at this timing, because it's the second day of trading for this company, and I think it has an incredible future. In fact, I called it my second Ethereum at $12 moment.
It's very interesting. Sounds like an interesting company. There's some really bearish people on Wall Street that are saying there's no use cases for blockchain technology whatsoever after a decade. And so maybe they did that just to short Bitcoin and make some extra money. I know there's a Department of Justice investigation now into price manipulation for spoofing, shorting Bitcoin. So we'll have to see what happens. But, I think there's going to be, in the short term, because that's the trend, there's going to be more blood on the streets. But I don't think all the cryptocurrencies are going to die. I mean, some of them are going to die, but long term, I don't think this industry is going away. I think, there's a lot, whether it's Wall Street, whether it's large corporations, whether it's Silicon Valley, they are making investments into integrating blockchain technology into different industries, like you said.
Oh, definitely. And the future is definitely going to have to get involved with cryptocurrencies and competing currencies and tokenization. I can give you an example of a company that is going to make a splash also in the future, and it's called Blockstrain. And they're a company that created a software specifically for the cannabis legalization of Canada, where all of the documentation from the genome, from the intellectual property, up until the point of sale, everything will be on the blockchain, and the government can come in there and see all the documents that they need, and the consumers can scan every product that they buy and see where it's coming from, what temperature it was grown at, where it was grown, all of that. And I think blockchain is going to be able to do that better than anything else. Now, that company in the future can create a token where the different growers can use the token to pay to each other for licenses of products. So, for example, if company A likes companies B production mechanism or the way that they grow their plants, they can license those plants from them using tokens. So there's a huge economy for this, and I am just very excited to be an investor at this point in time. Obviously, there's a lot of high-paying jobs in the industry as well. But $300,000-$500,000 a year if you can bring a lot of value to these companies. And yeah, man, what I really love about it is that it's something that can happen within North America, and the talent is here, the minds are here, the intellectual property is here, and this is part of the competitive advantage that the North Americans have. They have a very good human resource base for tech, and that's why you see all the big tech companies staying here, keeping their HQ here.
Yeah, they're just leaving Silicon Valley and they're going to Texas, or now they're coming to Northern Virginia now. They're getting tax breaks here. I think Amazon's about to move another headquarters here.
Yeah, definitely. Why not? I mean, it's smart, and California should realize that it needs to revolutionize the way that they tax companies.
Well, the politicians will just say that, oh, we'll just grow our tourism, or we'll just tax more people with property taxes. The politicians in California, as you know, I'm sure you agree with this. You're visiting California now. I think they're delusional.
Well, if you have a 250 million people already visiting a year, I mean, how many more people do you want? There's 250 million people supporting the tourism industry here. What California needs is a robust economy that has more to offer than just tourism, because tourism is already very, very strong here, and so I couldn't agree more. And cannabis is one of the things that they have done right. So yeah, I'm glad we touched upon many subjects here, Jason.
Yeah, I want to thank you for your time today, Lior. I actually grew up in Southern California, so I moved away almost 20 years ago. But that place is a mess. I wouldn't move back there right now. The taxes, the politicians have to totally change, and the taxes right there now. I've spoken with an accountant who my dad's friends with, and that guy's told me, like, you don't want to start a business in California right now. You don't want to move to California and move your business there. You just don't want to do it.
Sure, it's a regulatory mess.
Yes. Well, it's basically a European country at this point. I mean, they have all those assets, but they have tons of, agriculture, and they could be mining lots of metals. They just don't do it. They have lots of oil and energy. They don't want to do it. So they don't have a diversified economy, and it's a political problem there, and environmentalists and regulators. But Lior, I want to thank you again for your time today. If our listeners want to follow more of your work, how do they do so?
The best way to do it, and I was going to ask this, you can go to our website. You can look at our wealth library, which is the special reports tab, where you got a lot of aggregated PDF files from over the years. But honestly, the best way, because that's where I put all the highest priority reports and our top conviction ideas, is in the newsletter at wealthresearchgroup.com. It's free. We aim to keep it free forever, and therefore, it's just the best way to follow what we're doing. And that's it. I am very excited to be, sharing everything with your audience.
Excellent. Well, thank you again for your time, and enjoy your vacation in San Francisco.
Thanks. Thank you very much, Jason.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.